What What's up, Rebuke? Rebuke All Devils Radio. Rebuke All Devils Radio. 107.7. A hell of a name for a radio station. Rebuke All Devils. I'm with you, man. Rebuke All Devils. Put an addendum on it. At Uncivilized Much.
All right, welcome back to another edition of Rebuke All Devils Radio. And you're here with your host, Rebuke. And yo, I got a real disturbing clip I need y'all to listen to. These experts, courtesy of the Schwab Network, are talking like this is the end of the dollar. This is what we're seeing. We're starting to witness the end of the dollar. Okay? Now I'm gonna play this clip for y'all. Okay? Listen very carefully to what they have to say for fair use and educational purposes only. Roll that clip.
Headed next, I'd like to welcome in Ben McMillan, CIO of IDX Digital Assets. Ben, of course, gold just broke about 5,000 per troy ounce for the first time. What really do you see as the single most important driver behind this historic move? If there could be one single driver, I think there's a lot of things to factor in here, of course.
Yeah, the big one has been central bank buying. So if we look back to kind of pre-COVID levels, central banks in general, which historically have been kind of the largest holders of gold, they were buying about 500 tons a year of gold. Fast forward to right after COVID, which also, by the way, coincided with historic money printing by the United States, and you saw central banks ramp up those purchases to about 1,000 tons. So basically doubled, and it's been that ever since COVID. So for years, central banks have been basically buying twice as much gold as they ever have. And that was kind of the first part of the dollar debasement trade, which of course now is in the investing zeitgeist, and retail has moved into that. So to kind of follow back to those numbers, if we look at gold ETF inflows, they hit record highs last year. And so they're now close to eclipsing central bank buying. So, back to your original point about, what's driving this, it started with the central banks a couple of years ago. It really ramped up last year with, retail and broader investors, particularly in the US, starting to get in on the debasement trade. And that's why a lot of people are saying, this isn't necessarily a speculative rally. This is a resetting of the dollar relative to gold.
Ben, Chief Investment Officer, obviously you're thinking about where this fits into a portfolio, if it does, but I'm sure depending on the time, conversations around gold with clients can be tough because just anecdotally, you can look at it on a chart though as well. This asset class tends to be pretty dormant, kind of just like a doorstop until it isn't. And we're seeing what it looks like when it isn't now. That said, it still becomes one of those questions, and I'm sure it becomes more of a question: when do I get in? Do I sell it? Where does it fit in a portfolio? How much? How do you have those conversations?
You hit the nail on the head. That's an excellent point. And this is something, those were conversations we were having this time last year with clients, or even the year prior. We've been structurally bullish on gold, largely because of central bank buying, for a couple of years now. And clients said exactly what you were saying. They said, yeah, but look at it. It hasn't done anything for 10 years. It's dead money, doesn't earn a yield, all of the kind of traditional knocks on gold. And now, of course, everybody's piling in. You're seeing the big banks kind of, readjust, allocations within the 60-40 portfolio, upwards of 20% in some cases. So what does that mean? What does the outlook look now? Like I said, I think it's important. We've been telling clients, listen, now is not the time to necessarily load up the boat and chase returns, but you do probably need to have a structurally higher allocation to gold. Most folks we talk to, it's between 0 and 5%. There's very few people coming into this year that, we're really buying gold. And, yes, it's had a historic run. It's not likely, 2026 is going to look like 2025 in terms of returns. But the outlook still looks pretty good. And again, if we go back to kind of structural fundamentals at what's at play here, it's dollar debasement. G7 debt levels are just simply too high. We're seeing Japan have their reckoning. You're seeing central banks, think about who's the driver behind this. It's central banks. They're not speculative traders. They are structurally selling treasuries. They're buying gold. That's effectively coming off the marketplace for a long time. You've got retail buying increasing. So we continue to be structurally bullish on gold. It depends on the investor and the risk tolerance, but it's definitely something that, we're recommending at least 5%, upwards of, 10, 15%, depending on the investor in their portfolios.
Now, as you can hear, the dollar is in trouble. It's because there's nothing backing the dollar. There is no gold backing the dollar. There is no silver backing the dollar. And the American debt is so high, I think it's 38 trillion, to where the world knows these people are never going to pay that debt down, that deficit down. They're not. So it's going to have to collapse. There is no other choice. What we're listening to is coming from the experts. These are the experts. This is the game that they play all day, every day. Like we all have our careers and we go to work and stuff. This is what the experts do. Fair use.
Okay, you mentioned the debasement trade. I wanted to get your thoughts on that. I mean, where do you think that stands as far as being in, like the early innings, and perhaps why are you seeing it right now in this current environment?
So that's, I'm not going to bore you with a 60-minute TED Talk, but we are in the early innings of the debasement trade, and there's a couple of structural things there. The simplest is just supply and demand. The United States has, I think the number is 80% of all U.S. dollars have been printed since 2020. That's Econ 101. You've got too many dollars in the system. That's why we're seeing inflation. That's why we're seeing a rush to hard assets. I think the other thing too is elevated geopolitical risk. Historically, U.S. Treasuries have been the beneficiary of, geopolitical, flashpoints. And, with Russia and Ukraine, we started seeing much more of that move towards gold, crypto to a lesser degree. I think interestingly too, with the uprising in Iran a couple of weeks ago, the Treasury didn't move at all. It was all gold that got a bid from that. So I think increasingly too, the world is looking at it and saying, you know what, U.S. Treasuries is no longer my flight to safety asset. It's gold. And so I think, again, this is, and I've said this, for well over a year now, I think we are at the beginning of the end of, the dollar as the global reserve. And I think it's going to move to be gold.
Yeah, and I think that has definitely been evidenced by some of the performance and just the recent geopolitical really turbulence we've seen weigh in on these markets with gold and silver, actually, to also mention. Just really seeing a phenomenal outperformance. So really appreciate it. Great conversation. Wish we could actually talk more about this because it's such an really interesting and now critical component of this market. But we so appreciate it. Ben McMillan, CIO of IDX Digital Asset.
And there you have it, man. What more proof do you need? Excuse me. What more proof do you need? So, so what do we do with our dollars? If you're sitting on $1 million, you're sitting on $100,000, $200,000, $50,000, $10,000. What are you going to do with your dollars now? What are you going to do with them? The good thing about this that I heard was the expert said we at the beginning. So that means we have time to prepare. We have a little bit of time to prep, and we have a little bit of time to prepare for the collapse of the dollar. Because also, India and the EU signed a big trade deal today. Yeah, YouTube. So look at the headline. CNN, India, and Europe, both stung by Trump, turned to each other in the monster of all deals on trade. Look at this. Let's roll that clip for fair use and commentary purposes.
Prime Minister, distinguished friend, we did it. We delivered the mother of all deals. We are creating a market of 2 billion people. And this is the tale of two giants, the world's second and fourth largest economies. Two giants who choose partnership in a true win-win fashion.
There you have it. They called it the mother of all deals. And they cut America out. So, this is crazy. You know what I'm saying? But this is breaking news, man. Y'all stay tuned, and I'll catch y'all on the next show. Stay safe, and shalom.